The last thing we need is more U.S. government regulation. We already have more government regulation than we've ever had in the past because we keep getting more regulation piled on top of the existing regulations, yet the frauds continue. In fact, they get bigger. A lot of people don't even realize, but the SEC wasn't established until 1934. The New York Stock Exchange started in 1792. So we went 142 years without even having a Securities and Exchange Commission. We had a stock market, people invested, but they did so at their own risk. We had no protection from the U.S. government whatsoever, but investors were protected by the market. And the free market offers much better protection than does government regulation.
The United States currency's recent decline against other major currencies, a long-anticipated outcome, could have broad implications across multiple asset classes. Dollar weakness could further exacerbate the situation. Despite Jerome Powell's hawkish comments after the November Fed meeting, the dollar failed to make a new high. I think as it becomes more obvious that the dollar has seen its highs and is headed lower, I think you are going to get a rush to liquidate long dollar positions. The assumption was that the dollar would keep on rising. But the minute that momentum is lost, there is a tremendous downside as everybody looks to unwind those positions. Peter said. Chief economist and global strategist Peter Schiff took to Twitter and stated that we don't need more government regulation. He further said that there is a need for more free market regulation and personal responsibility. In detail, he mentioned that the NYSE, New York Stock Exchange, was established in the year 1792. Meanwhile, the SEC was not created until 1934. According to Schiff, let's end the Fed, government stimulus, subsidies, guarantees, and bailouts. We were better off without it. The ongoing debate for and against crypto regulations has divided the crypto market, with increased volatility, fear, uncertainty, and doubt on the rise among netizens. Understanding the impact of currency fluctuations on corporate performance and stock prices isn't investing 101. But it is an essential component of portfolio construction, especially now that an important shift may be underway. So let's dive into the video. Remember to like, subscribe, and drop your comments below.
The dollar got hit hard on Wednesday, and in fact, it's falling again here on Friday morning. The dollar index is back with a 105 handle. It's 105.85, getting very close to falling below 105. I think a close below 105 would be technically significant, although I'm not really sure we even need that at this point. I think we have enough evidence to say that the high in the dollar is in. The dollar index almost got to 115, and now we're back below 106. So that is a significant decline, and I expect the decline to accelerate, especially after we close below 105. Then I think we could really start seeing a weakening dollar, which again is going to be very problematic for the Fed because the weakening dollar is going to put more upward pressure on inflation. And ironically, of course, the reason the dollar is weakening is because the markets think that the Fed is winning its fight against inflation, and so it won't have to fight as hard in the future. And that is removing the supports from beneath the dollar, causing the dollar to tank. And now the very inflation that the markets thought the Fed was making progress in fighting is actually going to get worse. So the Fed will be a victim of its own success when it comes to inflation. But when the markets perceive this, I think it's really going to accelerate the movement out of US dollars and into alternatives. In fact, if you look at what's happening in the stock market itself, it's exactly what I've been forecasting with respect to the continued rotation out of momentum into value. I've been repeatedly saying that this next move up in the stock market is not going to be led by the leadership of the bubble, that these tech stocks, companies that don't earn any money, are not going to be leading the way. It's going to be value. It's going to be dividend-oriented stocks that are going to be the leaders in the next move up in the market. And in fact, not all stocks are going to move up. A lot of these money-losing companies are going to go down in an environment of high and rising inflation and rising long-term interest rates. And if you just look at the rallies that we've had to date in the US stock market indexes, the NASDAQ Composite and the Russell 2000 are the laggards. The NASDAQ is moved up 13.4% from the lows, and the Russell 2000, 13.5%, even though these indexes have had much bigger drops from their highs than the declines we saw in the S&P and the Dow. Yet the S&P has rallied 15.4% off its lows, and the Dow Jones 19.3%. And the reason the S&P is lagging the Dow is because you have more of the tech names in the S&P, and so the Dow has more value and dividend-paying stocks than the S&P, and that's why it's outperforming. But if you really want to look at some outperformance, look at the gold and silver mining stocks. The GDX is up 33.4% from its September low. The GDXJ, the junior mining stocks, is doing even better. That index is up 38.3% from its September low. And remember, these are the closes as of Wednesday. I don't know what they're going to do in today's session, but these are pretty big moves. In fact, these indexes are now at 5-month highs. You got to go all the way back to June to see these indexes trading at this level. And I think what's very technically significant is the fact that these indexes have taken out the August highs. And I think there's a long way to go that people not wait for investing in gold stocks to become all the rage. Invest in this sector long before then, because that's when you can buy the stocks cheap. Because in order to buy something cheap, you can't be in competition with a lot of other people, because when you have lots of buyers, they bid up the price and then the price isn't cheap. But when you don't have a lot of buyers, when you still have sellers, that's when you can get a bargain. And there are bargains galore despite this near 40% rise in the junior mining sector. These stocks are still very cheap.
In an environment characterized by high levels of inflation, gold would serve as insurance against the loss of confidence in fiat currencies such as the dollar, whose value is eroded due to the declining purchasing power. In addition, gold is also a response to the fear that governments would use inflation as a tool to artificially reduce the soaring debts contracted during the pandemic, which caused the debt to GDP ratios in the developed world to skyrocket to record highs. Peter said it's only a matter of time before investors realize that the price of gold is not only going to rise commensurate with the cost of producing it, but it's going to rise more. Because as investors lose confidence in the ability of the Fed and other central banks to rein in inflation, now they're more motivated to hedge against inflation because they can no longer count on the central banks to protect them. They have to look for their protection, and they can find it in gold. Peter further advised that this is the best time to buy gold, especially as the prices are still low, because as more people go into it, the prices would become too high and it would be scarce to purchase. What are your reservations about Peter Schiff's gold? Do you think it would rally as he has always projected? Do you think regulation of the crypto market is the best thing? Let us know what you think in the comment section below. Also, make sure to hit the like button, subscribe, and turn on notifications. Thanks for watching.